again thank you for joining us today for the second event in our Future of Finance series, Consumer Protection and the CFPB, What are the Consequences for Consumers? My name is Chad Reese, and I'm the Outreach Associate for Financial Markets in the Mercatus Center at George Mason University. The Mercatus Center is an academic research and outreach center located at George Mason University's Arlington campus. As the world's premier university source for market-oriented ideas, our goal is to bridge the gap between academic ideas and real-world policy problems. We believe the Mercatus Center is ideally positioned to host today's event, as we look forward to providing you with a blend of thoughtful policy analysis, robust academic research, and real-world examples relevant to your work. To that end, we're happy to welcome you to our panel discussion today, which we hope will address some of the key policy concerns regarding consumer credit regulation, including what we've seen from the CFPB so far, what we might expect in the future, and perhaps most importantly, the effects on everyday consumers and businesses. Because we have a full panel, I'll provide them each with a full introduction before their individual presentations instead of doing them all at once here. And first, I'd like to introduce our initial speaker, which will be Todd Zawicki. Professor Zawicki is a senior scholar and senior fellow with the F.A. Hayek Program for the Advanced Studies in Philosophy, Politics, and Economics at the Mercatus Center at George Mason University, and Foundation Professor of Law at George Mason University School of Law. He specializes in bankruptcy, contracts, commercial law, business associations, law and economics, and public choice in the law. Previously, Professor Zawicki was director of the Office of Public Policy Planning at the Federal Trade Commission and taught at Vanderbilt University Law School, Georgetown University Law Center, Boston College Law School, and the Mississippi College School of Law. Professor?
Thanks, Chad. And welcome everybody for coming out this morning. And what I'm going to talk about this morning is tying together some of the structural issues that people have been talking about with the CFPB related to the policy outputs that we're seeing so far at the CFPB, and talk about the idea of whether or not this novel agency that we've developed, which is basically this super independent agency, whether or not this makes sense in the sense of designing in a way that's different from all other agencies. Now, let me say at the outset, from the beginning for the CFPB, I've always supported the idea of a single agency, of having worked at the FTC and seen the difficulties of trying to coordinate consumer protection policy. It's always made sense to me to try to consolidate it in some way. And to some extent, my real concern about the CFPB has been that we've squandered an important opportunity. We've squandered an opportunity to have a really good, robust consumer protection agency, and a lot of it has to do with the way in which this agency has been designed. I call it the revenge of Richard Nixon, which is that the CFPB is designed like an agency that was frozen in amber in the 1970s. And completely ignored all the intervening things we've learned about how to devise agencies. And we learned that the hard way, which is in the 60s and 70s. We learned why we don't make agencies like we make the CFPB, which is a completely unaccountable agency that is resistant to all oversight. And we saw it in what administrative agencies did to the economy in the 60s and the 70s, which is this overhang of regulatory problems that stifled American competitiveness and the like. And what we saw and what we've understood since then is that bureaucracies are subject to various defects or pathologies, such as tunnel vision, focus on their goal, imperialism, which is overstepping their regulatory bounds and the things that they're good at, and a tendency to become highly political, which is that there is politics in this, and there's a tendency for them to substitute their own political views. And so what we've developed over time is two different ways of organizing agencies. Basically, executive agencies, in which the heads of the agencies are accountable to the president through the political system, and independent commissions. And basically, independent commissions substitute deliberation and congressional oversight for the kind of accountability we see in the executive. And the Federal Trade Commission is a good example of how the second group works, right? A bipartisan commission that basically the idea is through deliberation and congressional control can check these tendencies. The CFPB, of course, is neither. It's neither an executive agency nor an independent agency. And the rationale that's been given, among others, is the CFPB is different, that they engage in evidence-based policymaking. And so they don't need accountability. They don't need politics. They're above politics or immune to politics or something. They're just doing facts, not opinions. So they don't need the accountability of the political process, and they don't need the deliberation of an independent agency. But what we see, of course, is that the agency is extremely political. We've seen this both directly in terms of coordination with electoral politics, but also I suspect we're going to see our other sorts of, I'll talk about other sorts of things. And the real question here is there any reason to think that the CFPB is so different from the FTC that it should have this uniquely, radically independent culture? Or would the CFPB actually be a better agency, if it was subject to the checks and balances that we've seen that all other agencies have needed over time? And so I'm going to examine in my remarks today this idea of evidence-based policymaking to see whether or not this is true in fact. Let's start off with the qualified mortgages study. This is a good example, which is a qualified mortgages study, which is the only study on complex mortgages that they cite during the in the qualified mortgages study. Found, this is out of Chicago Fed, found that we find that complex mortgages are used by households with high income levels and prime credit scores. It contrasts the low-income population targeted by subprime mortgages. And what they mean by these are like negative amortization mortgages and that sort of thing. And they go on to say that the reason why these mortgages have defaulted so much during the financial crisis is because they attract sophisticated borrowers who are more strategic in their default decisions, right? So basically what a negative amortization mortgage attracted was not poor subprime borrowers. What it attracted was high-income, highly sophisticated borrowers with very high FICO scores, and once their houses went down in value, they recognized it was a bad investment and walked away. Quite striking, the CFPB rule says, in their later incarnations, interest-only and negative amortizing loans were often sold on the basis of the consumer's ability to afford the initial payments and without regard to the consumer's ability to afford subsequent payments once the rate was recast. The lower payment possibility allowed people to qualify for these loans that they otherwise would have. The performance of many of these loans was also very poor and worse than expected with the onset of the downturn, citing the study I just told you. And then they go on to say that the QM rules are going to deal with these things by basically making sure that people have an ability to pay. Now, this says these defaults were high, but not because people couldn't pay, but because they catered to highly sophisticated, high-income borrowers who knew a bad investment when they saw it. Somehow this goes through the CFPB mill and the study gets interpreted and converted into something about the borrower's ability to pay. Now, I suggest there's no way to square what the study actually says with how the CFPB compares it, how the CFPB characterizes this this study. They also talk about teaser rates in the QM rule. And what we see is in this, they admit that, at least they admit that the evidence is mixed on this, yet they go on and essentially ban teaser rates in the QM rule, somehow suggesting that despite what they actually say about teaser rates, it somehow suggests that they should be banned. We also see the auto dealers rule as evidence of what's going on at the CFPB. Now, it would be hard to write a statute that was more clear than Section 1029A of Dodd-Frank. The Bureau may not exercise any rulemaking, supervisory, enforcement, or other authority over a motor vehicle dealer who is predominantly engaged in the sale and servicing of motor vehicles, the leasing or servicing of motor vehicles, or both, right? It's hard to read that and not say, okay, that means the CFPB doesn't have jurisdiction over auto dealers. Yet we know what they've done, right? Which is that the CFPB is basically regulating auto dealers through regulating indirect auto dealers, which is that basically by using the stick of the indirect lenders for auto dealers, they're basically not just regulating credit issued by auto dealers, but they're actually regulating the ways in which auto dealers are paid, which is to say they're regulating the commissions, the way in which auto dealers can be paid with respect to this. And based on what? Not really clear. Based on some sort of vague allegations that somehow or another they've determined that there is a disparate impact with respect to the way in which auto dealers are made, and some sort of theory that changing the compensation scheme would somehow change these patterns of auto dealing. Now, why are they doing this? Well, it's easy to understand this in our theory of bureaucratic behavior that we started out on the front end, right? Which is that there was this one little tiny zone out there dealing with auto dealers. They can regulate the entire world except for this one little tiny zone, but that was still too much to escape their purview. And so they conjure up this theory of in order to reach basically the one industry that they otherwise couldn't reach. Now, why would they do that? I mean, one of the things we see that is consistent with that is that by doing it the way they do it, they're not subject to the typical transparency requirements of a regulatory process. They're not even engaging in sort of direct litigation. What are they doing? They're basically deputizing private banks as arms of the federal government to regulate auto dealers, which I think is a really troubling development, without really thinking through all the possible implications that this might have, not only on auto financing for consumers, but on auto selling in the way in which auto financing is combined with auto selling. Last example I'll give are data mining operations. And this is a quite striking one, which is that CFPB wants to monitor about 85% of the credit cards and 90% of the mortgages that are issued in the country. So to give you a number, that's about 991 credit card accounts that they want to collect on an ongoing basis. Now, there's obviously a cost to this. There's a cost of providing this data, but there's also a potential cost to consumers, which is in testifying before Congress, Director Richard Cordray admitted that even though it's unlikely, it's possible that there might be data breaches. It's possible that this might be tracked back to particular consumers and the like. And so obviously we have a regulatory principle here, which is we only want to collect as much data as is necessary to further the CFPB's regulatory agenda, right? I mean, considering there's cost to both consumers and issuers from doing it. So the question is, do they need too much data? Or do they need that much data? They need 85% of credit card accounts. Would they be okay with, say, 70%, 50%? Would 450 million credit card accounts be enough? 300 million? Well, Thomas Stratman of the Mercatus Center submitted a letter that basically said about 1.4 million would be enough to further any conceivable regulatory goals. So it's estimated the CFPB collects about 70,000% more credit cards data than they would need for any regulatory purpose. And this is consistent with the idea of basically of just ignoring the costs that they're imposing on consumers and that sort of thing in favor of this tunnel vision regulatory regime that they have. So I'm going to close by just talking about why agency design matters then, and what I think are the lessons we take from here, which is I think the lessons are that, that bureaucracies are subject to predictable ways in which they behave. There's a reason why we have checks and balances on bureaucracies. We learned this the hard way in the 1960s and the 1970s when regulatory overreach caused a decline in economic competitiveness and the like. And we're learning it again now with the CFPB, which is that the kind of structures that we've seen on other agencies make sense, and they make sense for the CFPB as well. Tom is going to talk about installment lending, but there's another history that goes along with this, which is the history in the past in the United States when we've had periods of usury regulations, when we've had periods of poorly considered economic analysis, and the impact that has had on consumers and on consumer credit markets. And so I'm afraid that we're going to be relearning this history, and Tom is going to talk about a bit of this in terms of the unintended consequences of poor regulatory design. But what I think the lesson we take away from this is that the claim that the CFPB is special, that the CFPB should not be subject to the same sort of regulatory rules that we and design that we have for other agencies, in fact, is turning out to be a flawed hope. Thanks.
Thank you very much, Todd. We'll now hear from Aaron Klein, Director of the Financial Regulatory Reform Initiative at the Bipartisan Policy Center. Previously, Klein served as the Treasury Department as the Deputy Assistant Secretary for Economic Policy and Policy Coordination. In that capacity, he has worked on financial regulatory reform issues, including crafting and helping secure passage of the Dodd-Frank Wall Street Reform and Consumer Protection Act. He also played a leading role in housing finance reform, transportation, and infrastructure policy, as well as TARP implementation. Prior to his appointment in 2009, he served for over 8 years on the staff of the Senate Banking, Housing, and Urban Affairs Committee, most recently as Chief Economist. Klein?
Thank you. Thank you, Chad. Thank you, Aaron. Thank you, Hester. Thank the Mercatus Center for bringing us together, inviting me here today to discuss a very important topic, which is the Consumer Financial Protection Bureau. The Bipartisan Policy Center, where I am based and direct the Financial Regulatory Reform Initiative, conducted what I think is the first bipartisan analysis of the Bureau's of how the Bureau's been doing through its first 3 years. I'm going to summarize those reports, try and incorporate a little bit of Todd's useful framing and insights here, and kind of give you the results of what our study was, which was over a year of kind of in-depth analysis and conversations with a very wide-ranging set of stakeholders. And there are a couple points that kind of, I think, are useful to start the process with. The first is that the Bureau, in 3 years, has done a lot. You can agree or disagree with what it's done, but for an agency that didn't exist to have promulgated as many rules as it has, it's actually the only financial regulatory reform agency who's met 100% of its statutory deadlines in Dodd-Frank. Many agencies struggle to reach 50%, still have. And the Bureau was given a bunch on a wide-ranging set of issues. It's a little bit puzzling to me that they were assigned to do the qualified mortgage rule, given all the other agencies that have spent all this time in housing, and that to some degree, the Bureau's main mission isn't based in the housing space as much as based in other types of consumer lending. They were given rule writing processes on remittances, how migrants send money home, and many other different ones. And so to that degree, you can agree or disagree with how the rules turned out, but they turned them out, which compared to, some could look at its sister organization, the Office of Financial Research, born in the same statute, the same age, maybe hasn't really met as many of its targets or goals in terms of being up and running and functional. So there was a little bit of what we'll call a secret sauce that we think governed when the Bureau got things more right than wrong and more wrong than right. And that has to do with their process, kind of points that Todd raised. When the Bureau conducted an open process, went through the notice and comment period, had a lot of stakeholder outreach and engagement, put out proposals, showed the ability and willingness to modify those proposals in light of additional comments. By the time they got to the end, we think they came to mostly reasonable conclusions. You can agree or disagree with their rule on QM, you can agree or disagree with their rule on remittances, but those were examples where the Bureau followed an open process and came out to a reasonable set of conclusions. Plenty of people disagree with it. I think Barney Frank called the QM exception his greatest regret in Dodd-Frank. That being said, we think those were evidence of fair processes. The times that the Bureau operated in a more closed manner, didn't seek public input or sought it in kind of opaque, not opaque is the wrong word, tangential ways. They kind of asked for comment on one thing and then did something else and said, these two things are related, and there was a comment period. Or kind of thought just within the box of their own Bureau, even if that was outside the box, thinking compared to other regulators, but didn't communicate that. We seem to notice a pattern of mistakes. Their decision to include enforcement attorneys in examination processes with financial institutions, their kind of strange rule on how they were going to spend their financial education money, targeting families of military, those in the military and on the base community, and then all underserved people. So you kind of have a very small military community plus 100 million people, and those are designed together for the same program. And these things kind of seem to have been ginned up through an internal process, which may have been very robust, but didn't have that back and forth with the outside world that seems to have produced a better process and better outcome in other spaces. So our big meta finding was that the Bureau, and this is a push and pull, takes a little longer to go through the notice and public comment period. It takes longer when you're willing to edit draft regulations and make substantive changes before things go final. But you get it right, or closer to right. It's quicker to work internally, but often you don't get to the right policy choice. Another example of that would be kind of, that insight then steps back and says, well, should you do more guidance, or should you do more things not through the guidance or notice and rulemaking? And we said, when possible, you should veer more towards notice and rulemaking, where you interpret this than kind of guidance, which just comes straight out. And that was our meta finding on how the Bureau is working and how that's resulting in the quality of their product. The second big finding we had was that they've taken a very alternative structure to regulating banks and financial institutions over $10 billion. And that is they're doing a product-based regulatory structure as opposed to an institution-based structure. That may not be a bad thing. Looking at products across the industry and doing a product-based examination can be an insightful complement to the institution-based examination process the other bank regulators do. However, when you have an institution-based system that all the other bank regulators use, they have to close out exams, they have to produce CAMEL ratings, they have to produce CRA ratings, and for all of those factors, the bank regulators rely on the Bureau for important input. The Bureau process, it's not clear to us, is capable of meshing with the calendar-based institution process. Put another way, if you have a very large bank and they're on an 18-month exam cycle, and the examiner says, listen, we're getting ready to put it out, what have you seen? And the Bureau says, well, we saw this in credit cards, we saw this in student loans, but we can't tell you about the institution because we're still looking at mortgages, auto, installment loans. And they go, well, wait, when do you expect to have that happen? Well, 4 or 5 years from now, we'll have gone through all the products, and then we'll come back to the original products. The two cycles don't quite mesh, and the system has to adapt for that. There needs to be better information sharing. The primary regulators may not be able to rely on a full examination of all products within their cycle from the Bureau, and that may be okay. But the two systems need to do a far better job of coordinating, of information sharing, and that's not just information that you've gotten, but when you go to ask for information, there should be one set of data requests between the organizations. So we called on a lot more coordination and collaboration from the Bureau to the regulators, and we call on the Bureau doing a much better job to close out their exams. The Bureau, in fairness, kind of said back to us, listen, when you're starting an organization from scratch, the first set of exams you want to level set. You don't want to have major regional differences in the quality of regulation, and that was something that was a problem in the prior system. I mean, you see major regional, the OTS, to kind of pick on the most guilty party who's no longer with us, their West region had some serious problems, right? I think eventually the director of that region was removed for cause. So there are regional differences. If you look at the patterns of bank failure, something happened in Georgia. Their bank failures per capita were way out of line with everybody else. So there's a little bit of sympathy that in this first go around you do want to level set and make sure that what's being done is being done across the board. But they need to do a better job of examination. The third and final point has to do with data. Tom made a great point about data security. I'd emphasize not just from the amount of data that they have, but if the Bureau has a special meshing that it's the consumer's person, it's the consumer's regulator, it's the one the consumer should go to, that implies a higher level of standard and trust than the financial industry with respect, financial industry regulators, with respect to data. So the Bureau can't, given what they're trying to accomplish, they can't be at the industry standard. They have to be on the cutting edge of data security, because a data breach would be tremendously damaging to their reputation for consumers. On that point, the data portal that the Bureau is operating, we think is one of the potential significant bright spots going forward, where the Bureau can serve a very useful role in improving the accuracy of data reporting. It's estimated that 25% of consumers have some sort of error on their credit report. I can tell you that there are a few other Aaron Kleins out there that have done me no favors. And if you've ever tried to get something removed from your credit report, it can become a Kafkaesque process. Better data gathering and credit reporting, more accurate, is in everybody's best interest. It's a pure economic win. There's a cost borne by the Bureau, the credit bureaus who improve the quality of their data. Whether that cost can then be monetized in higher profits on their end for more accurate data is unclear, whether there's a market failure there or not. But the data portal and the way the consumer CFPB is going about it is a potential avenue to significantly improve some of this quality. The concern that we have is based on the size of the Bureau. I think the data portals had hundreds of thousands of hits. If 25% of credit files have some error in them, and everybody went to the portal at the same time, there'd be a huge crash. They couldn't possibly handle that pipeline of information, and it's a little tricky on their end how you roll out a process that potentially has these benefits without getting over swamped, especially in the age of social media, where there seem to be tipping point phenomena, where things go from very few people have heard about it, and now that I've let the cat out of the bag, I urge everybody here to check their own credit file, and if you see a problem, go to contact the Bureau, but also the Credit Reporting Bureau and the CFPB. See for yourself which one kind of generates change the fastest. But then how do you kind of get that process to roll out full scale without swamping the Bureau, either sets of bureaus? Going forward, we've been pleased that the Bureau has taken some of our recommendations to heart. About a month after we released our report, they released, actually they didn't do it in a release, they did it in a CFPB-wide meeting, where Director Cordray said that they were no longer going to have examination attorneys in, enforcement attorneys in examination. We thought that was a process forward. We asked them to hit the reset button on their financial literacy program. That hasn't happened yet. Multiple members of Congress asked the director to his thoughts on the idea of having more public notice and comment process. He said he was very open to that. He recently gave a speech talking about rethinking that process, which is an interesting idea. And lastly, Senator Elizabeth Warren picked up on one of the recommendations on our report, which was we think this auto dealer carve-out didn't make any sense. If the Bureau is supposed to regulate all products, they should regulate all products. For most people, an auto loan is their second biggest loan behind the mortgage. A third of Americans have no mortgage. For many of them, the auto loan is their single biggest loan. It seemed that carve-out, which I'll point out in the legislative language and intent was very clear that it was supposed to be carved out, didn't make any sense to us. We made two legislative recommendations. That and the creation of an independent Inspector General office for the Bureau were those two. And we think those two changes to the statute, the changes we suggest to the Bureau, would make the process move better going forward. Thank you.
Thank you very much for those comments, Aaron. Next, we'll hear from Tom Durkin. Tom is specialized in the economics and regulation of consumer financial services in the federal government as senior economist at the Federal Reserve Board, in the academic arena as associate professor of finance at Pennsylvania State University, and in the private sector as chief economist of the American Financial Services Association. Tom?
Thanks, Chad. It's certainly my pleasure to be here, and I must tell you that the Mercatus people are very nice, except for one thing, and that is that they're tough. They tell you you've got to get off on time, and so while I love to talk about stuff and ad-lib and wander around and wave my arms and things like that, they told me you can't do that, and so not even any stories to start the program today, and so I apologize from that at the outset. Especially when what I'm going to talk about concerns unintended consequences. I mean, you know, how boring can that be without a story to get the audience moving a little bit? and especially because I'm going to talk about an old industry. It's really an old industry, one that's been around for a long time. I do have a new paper on this, though, with a colleague who's sitting here in the audience, Greg Elliehausen, and also Min Wang at George Washington University, and it is results of some new survey data that the American Financial Services Association has received from its members, and I'll get into that in a moment. But the point is that while this is new, this is not a new industry. It's an old industry. It's been around for a long time, but there hasn't been much study on this industry for a long time. And the new paper shows that there also hasn't been a lot of change in this industry. This is an industry that shows great stability. There actually was a report from the Department of Banking in the state of North Carolina a couple years ago that said that some of the companies there making these installment loans said that this was an old line product and that they were proud of that. Well, that's what I've seen also. It's an interesting phenomenon, I think. But sometimes, nonetheless, that this is an industry that's been overlooked, and I have found through some experience in talking to people that there's not a lot of recognition of this industry anymore, who it is, what it is, where it came from, and so on, so forth. It was common in the past, but I'd like to talk for a few minutes about a few aspects of background that I think are worth mentioning, maybe as important as talking about where the industry is today and what we found out from the survey results. So I mentioned that there's relatively few studies in recent years, but I have a deep archive and a good collection of these studies, and I'll just show them to you, and you might ask, why am I doing that? It's not because I participated in these studies years ago, what I did. It actually was when I was a graduate student, and now I have white hair. But the point is to show you visual cues that you know that in fact studies do exist, that you can find these, you can read them if you want to, and that you'll find there's a lot of good information in these studies, and it's worth looking into that, I think. But even then, 40 years ago, when these studies were new, this was not a new industry. At that time, there was another book written, actually about 50 years ago now, by a man by the name of Irving Michelman. This study, if you're going to read one of them, this is a really good one, I think. Irving Michelman wrote a history of this industry from the perspective of 50 years ago, and it's interesting to see what he said about that 50 years. Of course, he was wrong what happened after that, because he predicted that this industry would continue to expand and become better and better known and so forth, when in fact that hasn't turned out. And I think that's due to some of the unintended consequences of regulation that have occurred over the years since then. But anyway, what he showed in that study, in that history, was that some of the most important things that happened to this industry actually happened as much as 100 years ago, that the big changes in this industry happened 100 years ago, and it expanded then for decades, up to about the end of the 1960s, and then it declined after that up to the present time. And what happened then, I won't have the time to get into this, but that the inflation that's taken place since then, together with the failure to update the regulations going forward, made the old business model largely unrealistic, and most places in the industry just tended to wither away in a lot of locations. Now, another aspect of background, and I'll be fast about this, but that this industry is tied up with what I would characterize as the oldest running public policy controversy. You can find, and that is rate ceilings on lending. You can find rate ceilings in written form in the Code of Hammurabi in the 18th century BC, and so it goes back that far. Historians believe that rate ceilings actually go back farther than that, into unrecorded tribal antiquity in Paleolithic times, and so Neolithic times. And so this is rate ceilings that still affect this industry, certainly something new. I would say that it's also worth noting that regulations like rate ceilings have implications. These things don't occur in a vacuum, that they have some implications. After all, why would we have regulations if they didn't have any implications? And so some of these things tend to be good, and some of them maybe not so good. But it's ultimately part of the question, the overarching question of whether credit use by consumers, personal credit use by consumers, is a good thing or a bad thing. That's what John Caskey, an academic at Swarthmore College who's written a lot about various consumer financial products, calls the big question. And so the big question still continues. It seems like the evidence of personal use of credit since the time of Hammurabi and through the regulations in ancient Greece and Rome in the Middle Ages, religious recommendations and regulations by the church, up into the 19th century when they were finally overturned in most European countries, that the demand has continued despite those centuries of regulation. And so the people, in some sense, have answered, I think, that credit helps them with their finances. It's not abusive, as sometimes people say. And nonetheless, the debate goes on. It continues. It seems that the centuries of use by consumers and the demand for the credit seems largely forgotten today. And that's the kind of discussion that Michelman gets into in the book. But it's also worth mentioning, I think the main point that you can learn if you haven't realized this from the Michelman book is that this industry, the installment loan industry, grew ultimately out of a fight that took place in the progressive era, namely when Woodrow Wilson was president of the United States, when people did not like an aspect of consumer lending in those days, and that was specifically what was characterized then as the loan shark problem. And so people got together at that time to try to find a way to get around that and to come up with a legal, regulated alternative to what was characterized and was a loan shark problem in those days. And so this industry, the installment loan industry, really came out of philanthropy. It was a bunch of philanthropists who got together from the Russell Sage Foundation, together with the National Conference of Social Workers, and they got together with a small group of willing lenders who were willing to be regulated and to do things the right way. I suspect they were not loan sharks to start with. They were people who wanted to do it the right way, and they knew they were in a bad industry because of some of the bad actors, and so they were willing to go along with regulation, and that led to the development of the law called the Uniform Small Loan Law, and that was the law that regulated this industry from 1916 to the present. It's interesting to note that the group of lenders at that time came from a group called the American Association of Small Loan Brokers, and after a half a dozen changes of name over the years and great growth in the membership of the association to worldwide financial institutions, it's now called the American Financial Services Association, and our next speaker is the chairman of the board of that. I'm very glad to have you to be on the same program with somebody who is now the head of that organization that in 1916 produced what was a solution to a social problem at that time. But we've met ourselves coming around. Nobody today recalls, except me with the white hair, recalls any of this and happens to own a copy of Michelman's book, knows any of this history, I guess, and that rate ceilings today in many places limit the kind of credit that these institutions are able to provide to solve this loan shark problem of a previous era. And so the unintended consequence is then that today we outlaw what was the cure for a social problem in an earlier progressive generation, while we look for a cure today for the same problem. And so you people who don't have the white hair, we old guys have to pass this on to. You have to supply that. All I can do is just shake my head and say, go figure, here we go again. Okay, now as I mentioned, I do have a new study of installment loans. It's really the first one in a long time, and I'd like to talk about that a little bit. I have I guess I had maybe the wrong slide up there because I wanted to put this one up to show that there's a couple of things I'm not going to talk about: the coverage, some of the difficulties of getting some of this going, the technical aspects, the legal aspects, and so forth and so on. They're interesting in themselves. I told you Mercatus is tough, and they're going to shoot me if I don't get off on time. And so I'm going to leave all that to any of you who want to know more about that. I'm certainly happy to talk about it. But I would like to say I think that the data themselves are pretty good, particularly here in the installment lending area. The AFSA survey has about 5 million loans, 5 million installment loans. Nobody's ever had a database of that size, and most of these loans are quite new when the survey is taken, and so the data are quite good. There's a lot of things that can be done with this. What I'd like to do now to talk for a couple minutes are some quick findings from the study. One of them is that these loans tend to be quite small. About 58% of them are $1,000 or less. About 5, 6 of them, 83% are $2,000 less. So these are relatively small loans to consumers. The maturities are short, but they are installment loans. So 69% of them are less than 1 year. So in other words, from 6 months to a year, 6 months to 12 months, 6 payments to 12 approximately, but 90% are from 6 payments to about 24 payments. So they're installment loans, but they're small and short term. The credit risk is clearly subprime. About 85% have credit scores below 660 and 70% below 620. So we're getting down into the deep subprime. These are people generally regarded as ration borrowers who cannot get all the credit they want from primary credit sources, and they rely on the installment loan industry to solve what I'm characterizing as a social problem when they need credit. We have delinquency measures in the survey. We find that delinquency is correlated with score, as you can imagine, specifically that the lower the score, the greater the delinquency. And there's no surprises in these data, and for those particularly who've looked at this industry in the past, but the lower the score, simply the higher the delinquency. Also, the larger the size of the loan, the lower the delinquency. So it looks like the lenders will take a risk on low quality borrowers, but they're only going to take a small risk. They only make a small loan to them, and the large loans then go to the people with the better credit scores. Talking a little bit about rates, that it turns out that the poorer risks also pay higher rates. Well, that's also makes sense that lenders are willing to lend a high rate to high risk people, but they have to get a rate in return to be able to lend to them. I will just mention the rough range of rates here, that more than 90% of the loans are between 19% and 99%. So that's a pretty broad range there, but 19 to 99% of the loans in the survey are in that range, and that tends to be the larger, the better credit scores and so forth. At the lower end of that, obviously, the smaller loans, the riskier ones tend to be at the higher one. That's exactly what the National Commission on Consumer Finance predicted. There was a federal government study commission many years ago now, but that's exactly what they predicted would happen in this industry, and in fact it's borne out by the survey results. Payment size are designed, it appears, to fit budgets. 83% of the loans have monthly payments in the range of $150 or less. And so, and again, it's correlated with size. So the smaller loans, smaller payments, as you would expect. Borrower age is a little bit skewed toward the younger, but not much compared to the population. So the way to put it is that these companies make loans across the age spectrum, younger borrowers, middle-aged, older borrowers, apparently as needed. One of the most interesting things, I think, is how dramatically these loans vary by state. 75% of the loans are in only 9 states. There are many states, quite a few states, with almost no loans at all. And that is largely a result, so it appears, specifically of regulation. In those states where there are no loans, those are also the low-rate states. In the states where there are loans that exist, again, I would characterize it as solving a social problem when the people need credit and can't get it anywhere else, that there are some states that have adjusted the rates or kept them at a level where these loans can be made. In sum, this was a complicated project, and I won't go down the listing again to summarize, but except for very quickly, they're small, they're short-term, they're high risk, they're high rate. The payments are designed to fit the budgets of the people who were borrowing. The age distribution is a little bit skewed toward the younger, but not a whole lot, and they vary substantially by location. Now, it seems that this latter, that it varies by location, suggests that there's not a consistent answer then among the states for those who want to carry on this debate of whether credit use is a good or bad thing. So, it seems to me there's never going to be an answer for that to those people, or for those people who want to carry on that debate. But let me close by saying that I would like to return to the heritage of the industry. It's to satisfy a need legally, it's to satisfy a need comfortably, but we've met ourselves coming around on this. We've forgotten where we came from in order to be what I would characterize as politically correct today about rates in a way that we think we do not like. But there's other ways to borrow too, and so I have one last slide from my deep archive, and that is my favorite New York newspaper. This is the way lending is done sometimes in other places, and when the loans are not adequate. It was interesting, you know, and Fat Tony there is Anthony Salerno. One of the investigators was also Salerno, and so they have apparently some kind of internal fight in the family. Tony was indicted for loan sharking, charging rates outside of the New York ceiling, and for authorizing and ordering the breaking of legs of customers. Now, that's not a nice bunch of folks, and if you think that you don't like regulated lending, that is the kind of thing that you can actually get into. There were and there are other ways to borrow, and I do have a variety of studies here too, again from my deep archives. Here's way that unregulated lending was done in Texas years ago. Here, and Texas solved this problem. Here's how it was done in most of the rest of the South. Most of the rest of the South also solved this problem. Here was one called the Loan Shark Racket, but this one was how lending was done in unregulated areas in New York. And I don't know how it's done there today, but New York laws still are not effective like the Texas and laws in some other southern states. In any case, it just simply seems, and the people, again, the tough people from Mercatus are waving at me from the back, that regulated lending just seems like a better way to go. Regulated in a way that allows these loans to be made to the people who need them. It's that simple.
Thank you very much, Tom, and I apologize for all the threats. What we didn't tell you was...
Were you going to break his legs?
we knew you were going to be a great speaker, but we don't want you to use up all your stories now so that we can come and invite you back for an event in the future and get these folks to come visit with us. We do have one final presentation before our Q&A begins, and shortly we'll hear from Gary L. Phillips. I thought that was the background for the rest of the presentation. Gary's been with Republic Finance since 1985, became Chief Executive Officer in 1989, and currently serves as Chairman and CEO. During his tenure, the company has grown from 21 branches in 2 states to 130 branches in 6 states. Gary has been an active member of AFSA since 1986 and currently serves as Chairman of the Board. He also serves on the AFSA Executive Committee and the AFSA Education Foundation Board of Directors. He is a former president of the National Installment Lenders Association, Chairman of the Board of the Louisiana Art and Science Museum, and former director of the Dunham School, and a former elder in the First Presbyterian Church of Baton Rouge. Gary? Let me make sure, is that your presentation? Yep. All right.
Good morning, everyone, and thanks to Chad. It is great to be here. I've been in installment lending for a long time, and I'm always willing to come and talk about installment lending and how it works and what it does for customers. Okay, a few topics. I'm going to tell you just a couple of things about Republic Finance in terms of how it fits into some of the data Tom mentioned. Some discussion about consequences, what happens in a regulated environment. And then I want to talk about some of the CFPB hot button issues and how they've already begun to affect us and what some of the consequences might be. We are relatively large for an installment lender. We're up to about 168,000 customers. We're now up to 135 branches in 6 states with 610 employees. And this is what our average loan looks like. So our average loan size is about $2,800, which is at the high end of the study that Tom referred to. Average monthly payment, $156. The term is about 25 months on average. Our average APR is 40.2%, and our average credit score is about 615. And so we are, as I talk, we are, again, a little bit larger. One of the things I would say, when I started with the company, our average loan size was probably $700 or $800. Some of what has happened, and I'm going to talk about this later on, we have moved to larger loans because we cannot make the smaller loans economically in the states we're in. Mississippi, for example, was one of our largest early states. Their rate cap with an origination fee is probably up to about 40%, but it's very difficult to make a $500 or $750 loan at 35 or 40% APR. Whoops. Structural elements of installment loans, these are the keys here. These are the elements that I think make traditional installment loans the safest and most affordable form of credit out there. They're underwritten to determine the willingness and ability to repay. They're always for a fixed set term. They're fixed equal payments. The rate is always fixed, and they're fully amortizing. So the customer knows exactly what they've got when they make a traditional installment loan. And the process is designed to discuss what that is. My take on this is the question is always how much for how long. It's what we try to do is set some range of credit for the customer. It could be $1,000 to $2,000, $2,000 to $4,000, and some term. And so when the customer comes to us with an application, what we're trying to do is if they say, okay, I need $1,500 for this, we'll say, okay, we can give you $1,500 and we can do it from 12 to 36 months. We can give you $1,000 and here's a way to make that work, and we can give you $2,000 and here's what that'll do for you. So we're always trying to have that conversation around how much for how long and what best suits them. Okay, regulations do have some consequences. Garnishment, for example, in some states we can garnish wages, in other states we can't. Our bad debt cost in states where we can't garnish is about 4% higher than it is in states where we do, and we have to pass that on to customers. That is included in most of the rate structures for the states. When the legislature set the rates, they do take that into account. The SAFE Act was a real estate licensing act a few years ago. We used to make a few small real estate loans. We don't anymore. We simply can't keep up with the regulatory burden and the continuing education. We made very narrowly defined real estate loans, typically 5 to 15 years, small dollars, a lot of first or second mortgages, fixed term, fixed rate. To be able to pass the test, you've got to know all there is to know about all forms of real estate lending, and those rules keep changing, and we just can't keep up with them. So most of my colleagues in the traditional small installment lending industry have quit making real estate loans entirely. Credit Card Act, in reverse, that has helped us. Our average Beacon score, it's now 615 or 618 actually. It's gone up from about 570 to 615 in the past 3 or 4 years as the bank customers who used to be bank credit card customers no longer have access to credit cards. They have come to us to meet their credit needs. So we have been trying to meet those, and our portfolio quality has improved accordingly. And then insurance licensing, again, our insurance license, and I'll come back to ancillary products in a minute, we are explicitly limited to what we can and can't sell, and we can only sell basically one form of product. So we would be interested in talking about how to do more, but we can't because of the regulations. Okay, now, as we go through some of the CFPB hot button issues, I want to tell you about 2 loans that I handled early in my career and explain what the current environment looks like. The first one was a family that had moved to Mississippi from Georgia, and shortly after they moved, they had a relative back in Georgia who passed away. They had to arrange funeral expenses back in Georgia. They were new in Mississippi, they had a job lined up, but they had not started their job yet, and they had no local credit references, no stability, no time in the community, no nothing. But they needed the money. So what I did, I actually called back to Georgia. They had some credit history in Georgia. I called back to the creditors. Their credit history was good. They'd done a good job. They seemed reliable. So at that point, it looks like they've got good character and a legitimate need, but they've got no income whatsoever. So it's very difficult to underwrite that loan. You know, if you're going to underwrite on the basis of ability to repay for somebody that has no income, that creates a challenge. I made that loan. So I made them a $500 loan. It was probably a 12-month loan. The payment would have been probably $50 or so, $50, $51, something like that. The next one was a single mom with 5 kids. All income in the family was from Social Security. Each of the 5 kids had a Social Security award, I think from their father, if I remember correctly. So the total family income was about $1,750. The mother and the 16-year-old son came in to apply. They had a meaningful need. I can't remember what it was, but they had a reason. They had a good reason. It wasn't frivolous by any stretch, and it was pressing. So they had something they had to get done. Their overall budget was reasonable, and they had some credit. So they looked good so far. The problem I started to have with this one, it was hard to figure out how to do this. And the mom looked like she was paying attention, But the 16-year-old son was really controlling the conversation. And the further I got into it after 2 or 3 days, I couldn't tell whether the mom was fully engaged and fully committed or not. I could also tell that if the son had been 18 instead of 16 and had come to me for the loan, I'd have made it in a heartbeat because he knew exactly what was going on, knew the finances. But I decided not to make that loan. And the reason I didn't make that loan was, as much as the 16-year-old knew, it's not right, and we teach to this day it's not right, to put somebody like that in a situation where they really may not understand what they're getting themselves into. So that one I turned down. I think they needed about $1,000. Okay, so now back to some of the CFPB issues. They really break down into 4 things. First, they're concerned with things that are set by statute or regulations, such as APR, credit insurance, those kinds of things. There are some industry-specific practices that I'll get into. Then they're also concerned with general business practices that take place in all industries. And then there are some things that are unique to the CFPB. The part of this is things that are set by statute or regulation. And I'm not sure, in my opinion, I'm not sure, Tom alluded to this, I'm not sure that the whole CFPB reason for existence is not an ongoing debate over rate caps. Cost is a big thing. Credit insurance is a big piece of our business. There's a lot of concern about closing fees and non-refundable finance charges in terms of are they renewed over and over and do they build up? And then there's also concern about the Rule of 78s, which is the method that we use to refund by. It's a mathematical formula that's been around forever. It's been in use since probably the teens and 20s. The reason it's still in use is because it was programmed into computers when computers started to enter into the mix. You know, we used to do all this by hand, and so people had to have a formula that they could relate to. And it's in statute, so that's why we use it, and that's typical of the industry. Okay, APR and cost. There's a lot of talk about 36%. Here are some numbers, and I've looked at numbers a lot of different times. I've got a good friend in AFSA that I've worked with on this. This is, a lot of people think that the main cost of a loan is the finance charge. It's really not. The finance charge has become a relatively low part of the loan. So these are some numbers, including average fixed cost, incremental costs, et cetera. And as you can see, if you want to make, say, a $500 loan, the break-even rate, not counting profit, is about 73%. You have to get all the way up to $2,500 to get to a rate that is sustainable at 35%. So if your interest is in loans under $2,000, which 83% of them are, then you can see that 36% is not going to get there. And I'm here to tell you, I've been doing this a long time. I'm interested in the discussion, but 36% is not a sustainable rate anymore. There has to be more revenue than that. We also talk about these loans as high cost. This chart basically shows that you have to think about that some. The black line that slopes from left to right is APR. The horizontal axis is loan size. The gold line that slopes up from left to right is the total cost of the loan. So if you start with a $500 loan on the left, the high line is a 60% APR, but the total cost for a 36-month loan would be about $270. Now that loan would be made for 12 months, not 36, so it would be even less. On the right-hand side, you look at a $5,000 loan. The APR on that's about 30 or 31%, and that's actually from our portfolio. The total cost on that loan, that might be a 36-month loan, so the total cost on that loan is $2,700. So to say, okay, rate's important, I get that, but to say that high APR equals high cost needs some further discussion because it's really not true. That $500 loan in our again, we do make some of them. The total finance charge would probably be $95 or $96 on a 12-month loan. That's $8 a month. And I don't think you can reasonably say that $8 a month is unreasonably costly. And again, you look at other things. In our portfolio, the finance charges are almost always less than the total amount of the loan because they're short-term. But the larger the loan, the lower the APR, but the higher the total cost. And we have to keep that in perspective when we're having the conversation. Now, industry-specific practices. This is where we start talking about trapped in the cycle of debt. I want to come back to insurance for just a second. One of the things that's going on, and I've been told this about CFPB, there are people at the CFPB who have been quoted as saying that insurance products may be add-ons that have no value. First of all, a financial transaction creates an insurance requirement. I mean, you need to balance your financial responsibilities with your insurance, and that's something that everybody should do. Our customers are woefully underinsured. When people say that these things have no value and imply that to our customer base, what they are really saying is that you as a customer can and should unilaterally transfer the responsibility for your financial obligations to somebody else at no additional cost if something goes wrong. And I have a problem with that. I don't think that's even ethical, much less financially practical. But that is the status of the debate on insurance. Now, I have particular knowledge of this one too. We're in the Gulf Coast, Louisiana and Mississippi. After Hurricane Katrina, we had 4 offices on the Gulf Coast that were basically flooded. And so we had customers leaving Mississippi going all over the country, and our carrier paid out hundreds, if not thousands of claims and hundreds of thousands and even millions of dollars in credit insurance claims when other people couldn't get them. So these things do have value. Now granted, we can talk about rate, but to say that they are not valuable at all really skews the process, and it's something that we need to be very careful about. Okay, trapped in the cycle of debt and refinancing, the question there are a couple things I look at. First of all, is the payment affordable? And the answer is always yes. We structure these loans to make the payment affordable, and we have decades of track record that shows that in most cases the payment is affordable because the customers actually do pay it back. Is refinancing inevitable? No. We do refinancings. People's circumstances change, but most of our refinancing, and this is true across the industry, is because circumstances change. People make a 6-month loan or a 60-month loan. Somewhere along the line, something changes and they refinance the loan. It's not because the original loan wasn't affordable, it's a change. Now, I want to get back to the first loan I made, the family from Georgia. Anybody want to guess what the outcome on that loan was? It was a first payment default, so they did not make their first payment. I'm the new kid on the block. You cannot imagine how much flack I caught when they didn't even make their first payment. However, the branch worked with them. I'd been relief managing. They made a few payments subsequent to that. Then they refinanced the loan a couple of times after that. And then at that point, they finally ultimately paid the loan off. And that was like a 2 or 3 year process, but it worked. Now, the thing about this is, without the option of refinancing, it would have been a charge-off right from the get-go. They would not have been able to pay that loan off because they were getting situated. And so, again, as I move toward closing here, this is one of the key things. If we get to the point where the number of refinancings is the only measure of whether or not a loan was properly made and underwritten and was effective for the customer, then a loan like the one I made will never get made because there are no guarantees on the front end of that loan that it is going to get paid. I had a customer that had a real meaningful need and a track record that said they could do it, but there was a problem. And so I took the chance. And I would really encourage all of the people who work at Republic Finance now to take the same chance and even for larger dollars because it's a bet that can be made. I do think, again, in our rate environment, the actual cost of the credit, the interest cost is not unreasonable to that customer. But if we get to the point where it's all about the refinancing statistics, then a lot of those loans are not going to be made. And that may seem like an extreme case, but in the space that we work in, a lot of the loans are like that. There are none that are black and white, that are perfect. Everybody's got a problem. If they didn't have a problem, they would have paid their credit card bill on an ongoing basis. So we have to deal with those problems. As far as the other one, the one, we took 3 days on the family with the 5 kids. That loan won't even get looked at. There's no chance because there were too many variables in that loan that would be too difficult to explain if you've got to explain them to a regulator after the fact if there's been a problem with the loan. So that loan would be rejected out of hand. Now, I still don't think that loan should be made for different reasons, but we do try to look at them. And so when it comes down to all of the discussion going on today, that's the issue. Are we going to take the time to look at these loans and try to make them work and try to allow the customer to work themselves out of the problem that they have, or are we, because of the regulatory environment we live in, going to begin to restrict the base, the customer pool that we can actually make a loan to? And I think that's a real risk. I think that's kind of, the discussion about credit insurance is important to my niche of the industry. We do have to have the revenue. The legislatures in the states have set up our regulatory scheme. So we cannot, they expect us to sell a certain amount of credit insurance, and we try to do that. If we get to the point where credit insurance is seen as no value for anybody and we can't sell it anymore one way or another, then we're going to have a problem in terms of being able to make the loans. And people like those two applicants will have no chance of getting a loan. Now, that, again, may not, we can debate that. The question about whether or not, I think Tom raised, whether or not credit is a good thing, people can have that debate. But I guarantee you, again, for me, after 28 years in the industry, I've made hundreds of these loans and collected thousands of these loans. We make them with the best information we have at the time, and we make them in what we believe is the best interest of the customer as well as our own best interest. We believe when we underwrite them, if we make them, we think they're affordable, we think the customer has the willingness to repay, the desire to repay, and a legitimate need for the money. And I think that's very valuable because not only is that economically meaningful, these people, we help these people, we treat them with dignity and respect, and they appreciate that. Our customers in focus group after focus group after focus group say that they like the traditional installment lending industry because we respect them, we work with them, and we try to do the right thing by them. And that, I believe, is true, and I think that is really important. Now, in the CFPB, the final thing about the implications now, they're a tool of choice for us because we're not specifically mentioned in the Dodd-Frank legislation. The idea was that they would do a large participant rule for traditional installment lending and then supervise some of the large installment lenders. They have not done that yet. So the tool they use is an enforcement action on the basis of unfair, deceptive, or abusive practices. And again, this politicizes the thing so much that it is very difficult to have a discussion and come to the right answer if we're going to be found guilty after the fact, because even though circumstances have changed. So it's going to be a very, very difficult situation for my industry to navigate. I do think the CFPB so far, I give them full credit. They've been very thoughtful and responsive so far, so I think they're trying to get it right. But again, back to Todd's point, the dynamics are such, and we even see this in the database, the consumer database. We have had a total of 7 complaints so far in the consumer database. We have complaints with our customers on an ongoing basis and have had them for years, and we resolve them. Of the 7, 6 of the complaints were completely legitimate, and we got the word from the CFPB as to what the issue was. We called the customer. They said, here's what my concern. We said, okay, great, we can see that. Here's what we'll do. They said, that sounds fine, end of story. The 7th one was a completely bogus claim. The guy said, I have these concerns, sent them to the CFPB. We called the guy back and said, okay, tell us. He told us. I said, okay, well, okay, fine. We'll take your word for it. We'll do this, 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 and this, which addresses your points. His next phone call was, look, I appreciate your effort, but the CFPB is handling that for me. They have got attorneys who are going to look into that for me. They've got some attorneys that are going to handle my case for me. And as a matter of fact, you're in the gun sights of the CFPB attorneys. Now, that's a direct quote from the customer. So we gave him everything he wanted and more, and then he said, that's not good enough. I want the CFPB to do something else for you. The database, and here, this gets back to the structure of the CFPB. Complaints have always been enlightened self-interest. We want to get paid, but we want to do the right thing. The customer wants a break, but doesn't want to, most customers don't want to be unreasonable. You get this consumer portal involved, and all of a sudden the dynamics change. First of all, there are a lot of people within and without the CFPB who have an agenda. They're trying and going to try to drive claims to this database. So that distorts the process. Second of all, the CFPB is predisposed to, I believe, believe the worst on the front end. So we have to overcome that barrier. If we're going to do something, we have to explain why we're going to do it and why it fits and all of those kinds of things. Now, in the past, we've always done it we've given people the benefit of the doubt, but our economics are already changing around complaints, and it is going to be much more difficult for us to resolve complaints in the future because of the dynamics of the CFPB database. And as a result of that, and in everything else we do as a result of this, we're going to be less responsive, less flexible, it will be more costly to us, and ultimately that will raise costs to the customers. And so those are some of the implications. And those are just a few examples of areas where the CFPB has been influencing us already, but it's going to have a big impact, not only on our profitability, but in terms of access to credit for a big segment of the population and the cost of that credit. and it's unavoidable under the current structure.
Thank you very much, Gary, and I hope you all join me in thanking all of our panelists for their presentations today. We do have a little bit of time left for Q&A. I don't know if all of you can see it, but there is a standing microphone here just on the other side of this pillar. I'll go ahead and start closing out, but if anyone does have a question, please feel free to go ahead and step up and identify yourself, and you can either request a question of a specific member of the panel, or if you just like to have everybody take a shot at it, feel free to do so. I hope this has been enlightening and useful for folks. Again, as I mentioned at the beginning of the program, what we've tried to do is bring together a blend of policy analysis, academic research, and real-world examples. And it's certainly a topic area that hits on a lot of issue areas. So I would like to thank our installment lending presentations for offering a little bit of clarity and specificity to the debate, as well as to Aaron and Todd for giving us an overview of the overall issue. I'll throw out the first question if we don't have any other folks in line right now. And that is that our audience is composed of kind of a mix of policy folks as well as congressional and agency staff. So for those of you on the panel, if you could offer one takeaway, either one reform suggestion or one research need, depending on who they are, what might that one takeaway be for the one change in the policy arena that needs to take place or you'd like to see take place, or the one area that is still unsettled and we'd like to see a little bit more research done on the topic? And anyone can jump in.
Yeah, I'll jump in. I mean, one of the things I didn't talk that much about, but I think comes out of Gary's presentation is the reality that you cannot wish away the demand for credit. If you need $500 to fix your transmission to get to work so you don't get fired on Monday, you need $500 whether you have the bank or not. And that's the reality of things, right? And that's what we're seeing is we're seeing, and we've seen this historically, and Tom makes this point, right? You squeeze the balloon and you make it harder to get a credit card, right? So the Credit Card Act has made it harder to get a credit card, especially for lower income borrowers. And Greg Eliason has a paper that shows the dramatic decline in access to credit cards in the lowest quintiles. And as Gary said, that's good for installment lending, but because all those people who used to have credit cards are a lot more good risk, but now they're in installment loans. You also see the point he makes that where APR caps are low, minimum loan sizes go up, which basically makes consumers perhaps borrow more than they want to, but also creates an underserviced niche. And in many ways, that's where payday loans fill that niche for people who can't get installment loans because the regulatory process or just the economics of it means that they can't get can't get loans. If you take away payday loans, then we've got other options, right? As you keep pushing people down the ladder, you take away credit cards, you push people to other things. You take away those things, you push people to other things. You can't wish away the need for credit. And Tom put up our friend Fat Tony, but Fat Tony was running $80 million a day on the streets of New York City in the 1970s. I did an inflation calculator. I think it's like $4 billion or something like that in current dollars. That was just in New York City. 80 million a day is what the newspaper story says. So yeah, outstanding in New York City. In 1968, the Senate did a report. The Senate committee did a report that found that loan sharking is the second largest revenue source of the mafia in 1968, behind only illegal gambling, except the loan sharking was more profitable, so they used their illegal gambling revenues to fund their loan sharking operations. 1968, Richard Nixon's presidential nomination speech in Miami, one of the pledges he made was to appoint an attorney general who's going to go after the loan sharks in New York City, right? This is a real thing. Back in the good old days, when people couldn't get credit cards and everything else, the market emerges to meet these things, whether we like it or not. And so I think the lesson that Tom said is the lesson we've learned over and over again the hard way is it's better to have legal high-cost lending than lay breakers.
I can add one more thing to that too. Is and it's up on my slide, my advice would be, look, but be very careful. The use of data and the availability of broader-based data is making, and the analytical tools to go with it, is making a huge difference already that we already see in our company, and we see a lot of it in the industry. It's got the potential to completely change the cost structure and the decision-making process over time as this evolves. And so that, before we blow the industry up now, we do, I think, need to all take the time to see how that plays out, because I think that will be in the best interest of customers and lenders. Now, it is a broader conversation, and that's the second part of this. All of these topics are interrelated. I saw a statement in one of them, I think the Pew report the other day, that they were critical of somebody using funds flow data in a checking account. Okay, and that's fine if that's the position, but if funds flow data in a checking account gives you a more predictive and reliable way of assessing the ability and willingness to repay, then why not use it? Because that's better for all concerned. Now, again, there are broader issues in terms of privacy and those kinds of things, but that dynamic has the opportunity to really do a lot of good for a lot of people. But it takes some thought, and it takes thought in a non-politicized environment to get it right.
Aaron, did you have anything?
Yeah, I was going to take you up, Chad. You said one research and one policy.
And/or.
I'm going to take advantage of the end. So from a policy perspective, I think Gary made a very fair point on the complaint portal. Our recommendation was that the Bureau should publish its data on investigations in the aggregate in terms of which complaints were valid or not. So if there were, taking Gary's word, 7 complaints and 6 were legitimate and 1 was bogus, and the Bureau did that, they should publish that. Not just raw number of 7 complaints, but show 6 legitimate worked out, 1 bogus. I mean, I'm sure there are cases of people complaining who aren't even customers. And when the Bureau finds that out, it should segregate that out. They may not have the resources to do that analysis for everybody, but when they do, they should publish those findings. So that was my policy recommendation. My research question has to do with the point that Todd made about the person who needs to fix their car. And I think in Washington, it's very easy to lose sight of what the median income figures are in America, what it means to live on 30th percentile income, which by definition, 3 out of every 10 families live on that or less, and how hard it is to make ends meet in the aftermath of the Great Recession. And that may not always be the case for policymakers in Washington, but it is for people in reality. There's a distinction between people who are illiquid and who are insolvent. And that's the tough call that Gary has to make every day in making his loans, because if he's lending to illiquid people, over time they will be able to pay him back. If he's lending to insolvent people, that's not going to work out very well for Gary. How you figure out that is incredibly difficult from Gary's perspective. From the perspective of policymakers, at what level, if you're insolvent, then you shouldn't make the loan, right? That's not in Gary's best interest. The system should be set up to identify or make it as easy as possible for Gary to identify insolvent folk, because as you're insolvent, the more you borrow, the more charge-offs, and the more that raises rates for everybody, and it's not good for anybody. When you're illiquid, then your demand for that money is incredibly high, and your willingness to pay a rate is incredibly high, because if you lose your job because you can't fix your car, then you're way worse off than whatever rate you pay to finance the fixing of that car. What is that right rate from an economic perspective and a moral perspective? It's the Jewish holiday of Passover, and so a lot of holidays are fresh on my mind. One of the sins, and this goes back to Tom's presentation, one of the sins you atone for in Yom Kippur, and I don't know how old that service is, but it could get up to your 1800 BC, and certainly parts of it are older. We're in, I think, 5767 is the Hebrew year. Don't quote me on that. But one of them is charging usury interest to atone for us, and that was a bad thing if you charge people who are illiquid too high. Now, it doesn't specify the rate, which is probably a good thing, because I would say over the last 4,000 years, what a usury rate would have changed drastically. And that's a very tough question for people to struggle with. But if there was better information on understanding the distinction and ways to distinguish between a solvent and a liquid, I think we could make a big step going further.
Well, I've already said that you run into the danger of having me say anything because I just go on and on. I'll be really good and combine policy and research issue here by just saying, you know what, my recommendation would be just be suspicious of people with agendas. I mean, just look at the facts, look at the evidence, even get the back of an envelope and design some things, and you'll learn some things. And that's why I brought these things in as the visual cues. There's stuff out there. Think about it. Do it yourself. Ask people who are knowledgeable. Look for people who are skeptical. Be skeptical yourself. Those things are all useful. I mean, we talked about a bunch of things here. I'd love to get into credit insurance, for example. I have with Greg a couple of papers in credit insurance that are fairly new. But those things are not known. I'm not going to say be like me and read my studies or something like that, but be skeptical and read some studies or talk to some people and listen to Gary. There's a lot of stuff that's interesting. Don't fall into that trap of being agenda-driven or following people who are.
Can I add one sentence to amplify Aaron, which is a lot of times what the CFPB says they're going to do in their AMPRs and that sort of thing is, like for overdraft, they want to also study the cost of alternatives, right? But they never do, right? The alternative to overdraft protection is payday lending. The alternative to payday lending is overdraft protection. You have to study both of those together and regulate them together. In fact, I have a Mercatus paper on this very topic. But it makes the point, right? Which is to think about how people are using these products interchangeably. And that's the thing that they're not doing. And what's funny is they say they're going to do it, but they haven't actually been doing it.
And I want to comment on a couple things Aaron said, because to me, I agree with Aaron pretty well in terms of how he defined the dilemma in terms of insolvent versus illiquid. The main point there, that's why I raised the issue of data. If we're just looking at a budget, we're looking in a very narrow way. There is so much work being done in terms of alternative data sources to bring this to bear, to bring to bear on this problem, that I do believe over the next 5 to 10 years, we're going to have a lot better idea as an industry in terms of how to discriminate between who is insolvent and who is illiquid. And to me, again, there are lots of discussions that need to be had about the data and the privacy issues and all those kinds of things, but there is a huge opportunity here that will be a great benefit for customers and may get us beyond this. And I'm actually both optimistic and worried about that because it's going to be a source of competitive advantage for somebody. We're trying to figure out how to do it. And then one other thing I want to clear up, I talked about 6 legitimate complaints. This again, I didn't mean to imply that we had actually done anything wrong. But we do find out that the complaint process is there's more information out there. So finally, one of them was classic. We get ready to sue this guy because we can't find him. So all of a sudden, the complaint shows up in the CFPB database. He had been overseas. We got to know what he'd been in Africa for like 2 months, and so nobody was in touch with him. Well, he complained to the CFPB database. We got the complaint. We called him up. He said, "Look, I'll pay you. I just haven't been able to." It's like, oh, okay. So we presented the suit. The attorney waived all of the attorney fees, and the guy has basically been paying off his loan. That's the kind of thing when I talk about the dynamics. Now, historically, I've done just that. Most of the time, it's idiosyncratic things that create complaints, and we work with people and we give them the benefit of the doubt. The dynamics now add the 7th one, and it's a major problem for us. It's going to increase costs, and it's going to reduce flexibility.
Do we have one question here?
I'll start us off with this. Well, first, I want to know where you find mechanics that will repair a transmission for 5 years. You don't have to answer that. 2 questions. One for Aaron. Do you see any sort of resolution to the meshing of the prudential supervision and exams with the CFPB? And you noted that up, and you got a sense of whether or not there was something off in there. And then either to Tom or Gary or a combination, in terms of the distinctions, and I'm
say something about the first part of that, and then Mary can be more specific. But certainly the results in the survey are related to individual states. For example, in the state of Pennsylvania, we find that there's almost no small loans there, whereas in the state of Texas, which has a much different rate structure, there's lots of small loans there. And so a small loan in Texas is much smaller than a small loan in Pennsylvania. But if they put it, a small loan in Pennsylvania is much larger than a small loan in Texas. But of course, the states where there are a lot of both kinds of loans are the ones that are going to dominate today. So Texas, Oklahoma, Illinois, and a few other states like that. Whereas California, Massachusetts, Michigan, and New Jersey, places that have very few loans, that they're almost negligible in the data source. But
Well, I don't know that it's the demographics, the pure demographics are maybe not that different. In the states we're in, we're in 6 states, we get about the same amount of revenue, so it's really a creditworthiness issue, which may or may not be directly related to demographics. It's just hard to say. The way we look at it, we look at the creditworthiness, and we really are not paying all that much attention to the demographics. So I really don't know that there's a big difference that there is. The creditworthiness, there is a lot of correlation between size of loan and correlation and creditworthiness. We do, and so we are able to distinguish in a broad way less ability, less likeliness, smaller loan, more ability, more likeliness to repay, larger loan, and it plays out. But as to the demographics, I really can't say that there's a big difference.
So with regard to the Bureau's examination process, it's a little too early to tell whether or not they're succeeding in closing out more examinations. Some anecdotal evidence suggests they are, others suggest they aren't. There needs to be a framework and a mindset about closing these out and having a policy and process whereby the goal is to close an exam, right? Anecdotal story of, if you don't hear back from us, no news is good news is not the right answer. That being said, there does seem, and when we discussed this, and the Bureau asked to meet with us the day the report came out, and Director Cordray and Deputy Director Antomakis and the full staff, and there does seem to be a commitment at the top to making sure that the process for the loan examinations get closed out. Translating that into action still remains to be seen. With regard to coordinating the examination between the regulators, I think that's going to be an ongoing challenge in both directions. I think the bank regulators are going to have to figure out how to take into account the additional information that the Bureau can provide on the products they've looked at the institutions, but also understand that it's not been a holistic review that the bank regulators are used to. I think from the Bureau's perspective, they need to start thinking about coordinating and doing a better job. Their data sharing and their information gathering, and frankly, their timing of planning of going in for different products with the examination cycle. Congress left a little bit of a bifurcation of consumer regulation. Everybody says everything was given to the Bureau. That's not actually accurate. There's some fair housing laws, CRA rating, and other things that were left with the bank regulators. One finding that we didn't publish, and I'm always leery of what you didn't publish. That being said, we asked a lot of people, does it kind of make intellectual sense to move all that over? And the surprising finding we heard was no from both sides. Neither industry nor the consumer advocacy groups wanted the rest of those consumer laws to get moved over. They thought there was some steady equilibrium where it worked, which was a little bit surprising to us because we were a little intellectually open-minded to the idea of, the Bureau is supposed to have it all, give it all. So it seems as if there's a desire to continue that tension, and whether or not it can be made more healthy or not is still very much a work in progress.
With that, I think we're just about the end of our Q&A session, and we'd like to thank again everyone for coming out. If you have additional questions or would like more information to read studies by any of the folks up here, please don't hesitate to grab one of the Mercatus staff members here. I'm happy to chat with you myself if you have other questions or would like to speak with any of our scholars on the topic. Thank you all very much.